Good afternoon, everybody. Welcome back to Business Law 2. Today we're going to be talking about Chapter 37, which involves insurance. And so what I'm going to be covering in terms of overall learning objectives is to identify some basic terms and understand how the law kind of governs insurance contracts. We'll talk about some basic types of insurance, property, liability, and life insurance as a few examples. And then we'll look at some defenses against insurance companies by the insured in terms of representation, concealment, and warranties. So that's going to be big picture what we're looking at in this chapter. Anyway, when we talk about insurance policies, these policies are contracts. So everything that we learned in Business Law 1, if you can recall back that far, in terms of like the necessary elements to enter into a contract, all of those basic principles apply. So offer, acceptance, consideration, for a lawful purpose, parties containing contractual capacity, all that stuff that we talked about. So some key terms for insurance policies. So when I say policy, just think contract. So just some labels that we're going to discuss. So the insurer obviously is the firm that's promising to pay in the event of a loss or when that policy is triggered. The insured is the policy holder, so that's the customer. Policy is that written agreement, which we discussed. Insurance agents are where these are individuals that represent a single insurer. Whereas if someone is an insurance broker, they usually will represent a multiple or a variety of insurers. Sometimes where they have the ability to shop and try and give the insured a better rate, so they kind of shop around. But those are brokers as opposed to agents. Anyway, so the idea with an insurance policy, in terms of, as provisions are made by the insurer, consideration involves the premium payments that are made, whatever the agreement is, if it's monthly, quarterly, annually, and so, premised with that is, should an event occur that's covered under that policy, then it is the obligation of the insurer to pay out, whether it be to a beneficiary or to some other designated party, whatever the agreed upon terms are. The classic example would be the life insurance policy. When someone passes away, assuming they do have life insurance, then whoever they have designated as like the primary or secondary, depending on the nature of what happened, are the parties that would get compensated. So one of the key things to understand with insurance policies is this idea of having an insurable interest. And so normally insurance contracts are not going to be enforced unless the party that obtains insurance has that insurable interest. So for example, I have a couple of different life insurance policies that I have initiated through different employers over the years. And so I'm the one who initiated it. So certainly I have an insurable interest. If someone that I don't even know, or maybe someone I do know but I don't approve, if they get an insurance policy, a life insurance policy on me, the only way that's going to be binding or enforceable is if they can demonstrate that they have an insurable interest in my life. So a spouse, that is understandable. Children, I think you can make an argument that's understandable. But you start getting to like extended family members or just casual acquaintances, it's really hard to make that connection that they're relying upon me in some financial sense, that if I'm gone, meaning I've died, that they're going to sustain some kind of economic loss. So insurable interest, just to kind of nail that down, means number one, it's an insured who obtains insurance on themselves or property that they own, and that they will suffer a direct loss should something happen. The second instance is where it's the beneficiary who's the one that's trying to acquire the insurance. And again, they have to be able to expect that there is going to be some monetary gain from that person's continued life. And if their life ends, then they're going to sustain a monetary loss. But that's really key to kind of establishing that. So the insurance contract, normally, contracts are not heavily regulated by government, but regarding insurance policies, a lot of insurance, different types of policies and industries on a state-by-state basis are regulated. So not only is, when you think of the overall insurance contract, it has, certain like core kind of elements. So there's the initial application, whatever that is, life insurance, health insurance, property insurance, doesn't matter. All policies have an initial application. Then there are statutory provisions, and this is where the state can kind of regulate and say this is what's permitted or what's not permitted. I'm looking at my slide here, and I can tell that you probably cannot read the screen. So I do apologize about that. The lighting is kind of producing an effect where it's hard to see what's on the screen behind me. But anyway, if you open up the PowerPoint, the top box here says insurance contract, and then the bubbles, one says application, the other one statutory provisions, and the other one duty of the parties. So in terms of what's required under state statute, those are those statutory provisions, and then the actual duty of the parties. This is where you get into the heart of the contract. So usually the person that is insured, their primary obligation is to make sure that the policy is being paid for, regardless of the type of policy, auto, life, property insurance, whatever. If you're the insurer, your obligation is if an event occurs that is detailed in the policy, then you need to pay as per that requirement. So in terms of different types of like individual insurance, so from like think of more of a consumer perspective, and I'm not going to read all of these, but there's life insurance policy, and policies that involve life can either be like a term or maybe a whole life coverage. Term is where it terminates at some specific date, and it doesn't necessarily have a cash surrender value, whereas whole life, that lasts throughout the insured's entire life, and a portion of each premium is an investment that accumulates. So at some point there is a cash or surrender value if you want to kind of cash out of it. So those are just a couple of different types of life insurance policies. Health insurance, obviously, through employers, or if you get it on your own. Disability insurance, that covers for wages if someone is unable to work, whether that's a temporary or a permanent basis. Homeowners, automobile, and so on. And again, I think this is an area of the law, kind of like when we talked about landlord-tenant relations. I think a lot of people do have experience with regard to insurance policies. But if you do have a specific question that you need answering, please feel free to reach out to me, or we can discuss it in the discussion board section of the course. In terms of different types of commercial or business insurance policies, workers' compensation is really the big one for a lot of businesses, especially if you have a large workforce that's part of your company. And so that is required under state law in terms of being able to cover employees if they're injured on the job. The critical thing with workers' comp is that it has to be a work-related injury. There's certainly been many cases where workers are injured, let's say at home, or they on a weekend or something, and they somehow hobble into work, and then they kind of fabricate that the injury occurred in the workplace so that they can get workers' comp, but that would be an example of workers' comp fraud. But normally on a state-by-state basis, if you are injured in the workplace, you're going to be covered in terms of compensating you so that your medical bills and any lost wages are going to be covered for that. Now the flip side of that is usually, like with workers' comp, you're not going to be eligible to sue personally in tort. So if you remember in Business Law 1, when we talked about like tort lawsuits for personal injury, usually workers' comp is outside the scope of that. There still are attorneys who will represent you because they want to make sure that workers' comp is treating you fairly, but it's a different standard that gets applied there. It's not the tortious standard in that case. So you could conceivably, and this has happened many times, where there's some sort of hazard in the workplace. Customer slips and falls, they get injured, they can file a tort lawsuit. If an employee slips and falls, they cannot file a tort lawsuit. That's going to be something that goes through the workers' comp process. Like with individual types of insurance, businesses can get automobile insurance, property insurance. Um, Unlike individuals, there's malpractice insurance for professionals, business interruption insurance. Think of, anything that could somehow interrupt your business activity. The pandemic would be a great example of that. There's so many businesses across the state of Florida and our nation that have been just literally decimated because of the pandemic. And then just in general liability insurance. So these are just different policies that business owners are able to kind of take out. So, as I mentioned, when you're entering into these contracts that are called policies for insurance, the same things apply: offer, acceptance, consideration, lawful purpose, ability to contractual capacity, all that stuff. Um, all the information that is on that application, so that first kind of element or part of the overall contract, that is going to be binding on the applicant. So if you give misinformation, and to give you a great example, health insurance has changed a lot over the past like 10 years because of the Affordable Care Act. But pre-Affordable Care Act, pre-existing conditions was a big deal in health insurance, for those of you old enough to remember this. So if you had, let's say, heart disease, and maybe, okay, you're with an employer, you're in your 40s, and let's say you switch employers, and so, maybe now you're in your 50s, and they have a new health insurance company. And so your new health insurance company is going to ask you about all these pre-existing conditions. And in a lot of cases, they would not want to cover any type of medical treatment for that pre-existing condition. Another thing that happened pre-Affordable Care Act would be actual caps on coverage. So many health insurance policies capped you out at $1 million, and so if you had some sort of unusual disease or ailment that exceeded $1 million, your health insurance policy would not cover anything in excess of that. So applicants, what happened is that applicants started lying on their health insurance application, saying that I don't have this ailment, which this is not difficult information to find out from the insurer's perspective. They're able to get access to your healthcare records because they're offering health insurance to you. So, with the Affordable Care Act, that kind of eliminated some of those issues, so that people can just be honest now and they can say, yeah, I have heart disease, or, I had a stroke, or, whatever it is. And that, current and future health insurance companies cannot hold that against you. Or somehow, discriminate against you in terms of what they're going to cover or not cover as you have health-related ailments. So, there's a whole debate going on in our society right now about, the Affordable Care Act. Should it be kept or should it not be kept? But, that's the concern, not to take a position either way, but that is a concern if the ACA is completely thrown out, which, let's say it is at some point, whether Congress does it or if it's done by the courts. You technically are lifting that restriction on insurance companies so that they can go back to discriminating. I mean, they don't have to, but most insurance companies are for profit. And it's, if they don't have to cover something, they're not going to. That's how they make money. So, I don't know necessarily, where that leaves us if we live in a world where there's no Affordable Care Act, but, hopefully something would replace it if it is ever taken away. Anyway, don't mean to get off in the world of politics. So when interpreting an insurance contract or policy, so if you're a judge, and so let's say there's litigation that's resulted, they consider different things. Terms that are in conflict with statutes are going to be void. Insurance companies, I don't know, they usually know what they need to say or not say in a policy, but if they misstate something that is in violation of state law, then it just is void, whatever that is, even though it's in writing. Terms that are required by law are going to be implied if they're not expressly stated. And then laws requiring all terms to be stated, but if a term is not stated, that cannot be used to defeat a claim. So these are just some general judicial principles that courts will apply when evaluating the overall kind of veracity of a policy. In terms of other contract issues, anti-lapse and cancellation. So obviously when premiums are not paid, the contract lapses due to non-payment. Uh, a lot of states do offer for life insurance policies that there is a grace period. It could be up to a month. It depends on the state. So that would allow the insured the chance to get caught back up. Um, Also, the insurer may be required to, besides, paying up the policy, provide maybe for extended insurance for a set period of time, or maybe, pay the cash surrender value of the policy. So there's different things that could be applicable under state law. Modification, like with any contract, if both parties agree, you can change the original contract as long as it's for a lawful purpose and as long as everybody agrees to the policy change. Interpretation, same kind of rules apply when interpreting an insurance contract as you would with an ordinary contract. However, a lot of times the presumption is going to be against the insurer, because in that relationship between the company and the customer, obviously the company is the one that drafted the insurance agreement. And so, we're looking at the realm of like contracts of adhesion that we talked about in Business Law 1. The idea that, there might not really be a room to negotiate a lot of these elements of a policy. Some other contract issues, burden of proof, so if a claim is disputed, then it's the insured that has to prove that a loss occurred. So, if there was a fire, theft, if something happened, medically to you, receipts, and other documentation to prove that you did sustain a loss. Time limitation on the insured. This comes up a lot with life insurance policies. There usually is, and it varies from state to state, a time window in which, if you do have a life insurance policy, in order for the beneficiary to claim their benefits. And if you go outside that window, that's like a statute of limitations, and you lose the benefits of that contract. This is where it really does depend the type of life insurance policy. For example, one of my policies is through Valencia College. And so I would like to think that if I died, Valencia would figure that out rather quickly, if I don't show up to class. And then, HR, as part of, kind of like finding a replacement for me, they would also, look through my life insurance and notify the beneficiary that I have designated that they have funds that are coming to them. Now, the policy that I have that is just through a private insurer, the beneficiaries in that policy, they have been notified so that they know where the copy of the policy is, they know who to call when that day happens, for me. And so, that's the critical thing. You have to make sure beneficiaries know that they are a beneficiary. The last thing, it's kind of like when we talked about the wills. The last thing you want is, all your hard work, everything that represents your life. If your last wishes of who you would like to see benefits that you have accumulated in your life, in terms of who you would like to see that go to, it is an actual shame if it doesn't go to the correct parties. And with life insurance, insurance companies have no obligation to notify the beneficiary. I mean, I always say life insurance companies don't scan the obituaries every day looking to see, oh, did a policyholder die? And if so, we got to cut a check to a beneficiary. They don't do that. And so, they require someone to give them a heads up. Hey, this person died. Here's their death certificate. And, let's start processing the beneficiary, claim at that point. Some other life insurance issues, if you fail to update beneficiary information, there's been numerous cases litigated where, someone gets life insurance, let's say they're in their 20s, they're married, and, a lot of times you're on autopilot in life, and I get that, and you kind of forget about things. And let's say it's 10 years later, maybe you're on a second marriage, and let's say you die. So, if you didn't update your life insurance policy and it has your original spouse, from your first marriage, your life insurance is going to pay that money to the first spouse, not your current spouse. So it's always, always, always critical to update these types of contracts as life events occur. So just, keep that in mind. Usually, I have here like number two is designating only a primary beneficiary. That usually is not a problem because most insurance companies, they catch that and they insist that there is a primary and an alternate or secondary. Sometimes I've even seen a tertiary or a third beneficiary. Um, in the event, that, let's say that, if you're married, hopefully, let's say you have your spouse is your beneficiary and you are the beneficiary of your spouse's life insurance policy. I mean, what if you both pass at the same time in an accident? That's why you need to have backups so that, again, money will go to the intended beneficiary or beneficiaries. If you're going to be naming a child as a beneficiary, that's fine, but obviously insurance companies are not going to pay directly to minors. So you need, to either have created a trust or you have to have some sort of arrangements with, like, let's say a guardian, someone that's going to be taking custody of your child, and then the funds can go to him or her for the benefit of that child. Incontestability clauses, so that's commonly required by statute in life insurance policies, and it usually states that after 2 years the policy cannot be contested by the insurance company. And so that could maybe involve misrepresentation, fraud, or some other conduct, that could be related to that policy. So if you've been paying on it for 2 years, that gives insurance companies plenty enough time to figure out, has there been some sort of fraud in the creation of this policy. When we talk about property insurance, so, it could either be real property, so like, your home, your business structure, just raw land, you can get, coverage for that. Think of like forest fires and different things that can occur. And then also personal property, think of like renter's insurance. So, you might want to have coverage for your personal possessions. Again, always remember insurable interest, that you're the person that would suffer or sustain some kind of a loss. Normally with assignments, the insured may not assign a policy to cover someone else unless you have permission of the insurer. And, again, it's a discretionary thing that insurers may or may not permit you to do that. Injury normally does have to be accidental, so any intentional losses, that's not going to be covered. Arson sometimes is a question that students will ask about. If someone burns down their own structure, then what's going to happen there is not only is that going to be a violation of the policy, but it's also going to be a criminal act. So there's a couple of different problems with that. So don't commit arson. Liability insurance in general, that's similar to property insurance, and so that could even be part of the overall policy. It could be folded in together. No fault trends. Recovery for damages in an accident no longer depends on who is at fault in causing it, so it dispenses with that establishment of negligence when seeking recovery. And so a lot of policies, this comes up usually like with insurance, auto insurance policies, this idea of like no fault, so that you're covered no matter what. Even if the person doesn't have coverage, your policy can cover any kind of loss that you sustained, even though maybe you weren't at fault. Excuse me. With regard to some particularities with life insurance, suicide is one aspect of life insurance policies that arise. Most policies have a limitation that, again, if it's within that first 2-year period and someone commits suicide, then it's not going to be paid out. But then after it, it's just treated like any other form of death, accidental or otherwise. Murder, again, if it's by the beneficiary, then obviously that beneficiary is going to be barred from, recovering those funds because of the crime that they committed. If murder did occur, then we could possibly leap over the primary beneficiary and go to the secondary beneficiary or an alternate. That is usually how that would work at that point. Last slide, pardon me, for this chapter is just defenses that insurers can offer. So if there's some sort of like false representation, as long as it's material, by the insured during the application process, that usually is a justification for non-payment. Any type of concealment, and so sometimes that's linked with false representation, so that maybe you don't have all the material facts necessary to accurately assess the cost of insuring somebody. Think of like Lloyd's of London. That's a famous insurance company in England. And they're known, they'll insure anything, but obviously premiums are scaled to the level of risk, and that's where concealment sometimes comes in. And so be honest, and there are insurance companies out there that will cover you even if it's a high risk situation. It's just going to impact your premium amount. If you conceal thinking, well, I'm going to try and save money, well, okay, you might save money, but if and when it comes out, then you possibly are going to lose coverage at that point, and you don't want that. Warranties, so any material breach is going to be grounds for the insurer to avoid the contract and refuse to pay. So again, warranties is a catch-all category where it offers insurers, so the companies, the ability to kind of be able to say, I'm not going to pay. Anyway. I hope this was informative and helped you kind of, as you went through this chapter, you kind of, are able to kind of appreciate a little bit in more detail now the nuances of insurance policies. If you have questions, as always, please feel free to reach out to me anytime. I'd be happy to kind of answer any questions. You can email, call, or text me. Otherwise, have a very good, safe, and productive rest of the week, and I look forward to chatting with you all online. Thank you so much again for everything. Bye-bye.